This video is the first video of a series of videos to help you as a retail trader to be aware of a reality that is very common, but not commonly talked about or understood, which is manipulation in the financial markets. If most of the approaches that you have used so far have not worked out, if your stops are taken before the price goes to the direction you were before being taken out, if you have to reprogram or reformulate a back testing or a strategy, if you have not been able to find a repetitive process you can exploit to become profitable, watch these videos and subscribe to this channel. What is manipulation? One of the topics that are not talked about much in the trading community is manipulation. And it's interesting because many popular concepts and ideas will fall apart introducing this fact. A lot of companies, approaches, systems, and strategies will show their incongruity and fallibility if manipulation was understood by every retail participant, because then they will be less likely to fall for ideas that are too oversimplified and ignore the real business behind the charts, and therefore mislead people into beliefs, symbols, backtestings, and mostly ideologies that become an obstacle instead of solutions to take advantage of the financial markets and the business that works consistently for the owners of the business, the banks. If you go to Wikipedia, Investopedia, they clearly mention that the main participants in the financial markets are the biggest international banks, international institutions, and corporations. I have also read dozens of books and they actually acknowledge this fact, but that is it. It's like if we should not have to worry about them and just continue learning the hundreds and thousands of different approaches to see the market that is available to everyone with a computer and internet connection. Behind the curtains, where banks and corporations participate, is called the interbank market. The transactions between big participants can be very large, of millions and billions of dollars, but the interbank market does not have supervision or regulation. Then why would it be important to talk about manipulation? If I am developing a system based on past data, will manipulation affect me? Can I formulate manipulation? Is manipulation a matter that can be predicted? It is a conspiracy theory or is a reality? Why a lot of people just do not talk about it and better concentrate on their own predictions and opinions? Or why people talk too much about manipulation in a panic mode and every movement they see in the charts appears to be a deceit, and trading becomes about detecting and deducing traps and false breaks and secret patterns. In this series of videos, I will talk about manipulation as a reality and necessity, and why, if you understand it the earliest possible in your trading career, it will make things simple, and more important, will help you to filter a lot of useless information that is based mostly in myths, beliefs, and ideologies, and not in facts. You will understand why it's an unconditional process and is used every day as a tool to keep the banking business profitable, and is unconditional because it will happen with or without you, which also means that it will happen no matter what you think you know about the market. Will happen no matter what and how many indicators you're using, or what time frame you think is better. I think you get the point. Therefore, if that process will happen regardless, don't you think it should be taught everywhere as a fundamental understanding? The reality is that it is not convenient to the trading industry or the educational industry. And let's see some facts. This is very recent news. This is not conspiracy theory anymore. Manipulation is a fact. Now, we can think of these instances as isolated examples, or maybe These are just normal business processes. One important thing to understand about manipulation is that it's a constant process and that is necessary. And it occurs regardless of time frames, chart types, and it happens in any financial market. Let's see some examples so you become more aware of these processes that occur pretty much every day in different financial instruments. We're going to see different instruments, different examples, but at the end, my intention is that you are able to notice that there's actually a process that can be detected, understood, and can be followed, and ultimately exploded. Because it is unconditional, because it is not something you have to create, imagine, deduce, or backtest to formulate. It's a process that is a necessity for those who are the owners of the business. The big banks and the big participants. As you can see here, around 3 a.m. Eastern time, the London opening, we can see that the price starts going to reach previous levels. The price goes up, scores this point, reacts, goes to the opposite direction, scores this point, pulls back, and then goes higher, and then stays there for some hours. It keeps going there, and the day ends. The square that you see here is 1 day. So once that day is finished, the next day starts, and as you can see, around the same time, the London opening, the price just keeps going down. It scores this point, reacts, keeps going, and falls all the way below these previous levels that actually happened 2 days before. From there, the price reacts. But we have to understand, the price has been doing this, going a little bit higher, a little bit lower, a little bit higher, a little bit lower. Something to understand is that this process doesn't have a specific time. It cannot be generalized. It cannot be formulated. But the process can be exploded. Now the price goes below this point, which if you go by the ideology of lower lows and lower highs and the trend is your friend and all these truisms and ideas, at the end of the day, indicators are going to be given signals. There are patterns, supports can become resistance, trend lines can be drawn, formations can appear, but then the price is going to do the two things. It's going to keep going or it's going to change again. I don't want you to see this as how could I predict and what is the correct thing to do, but concentrate about the process which is unconditional, which at the end of the day has to do with accumulation of orders to buy or to sell. The big players, they need a counterpart. If they're buying, they need sellers. If they're selling, they need buyers. The day ends and the next day keeps going and regains all this movement that gained the previous day. So the question that you have to start making is, to whom is this convenient? Why the price has to go all the way down below these levels to then regain all that movement? And actually, if you follow up with this process, you will realize the price scores a point, pulls back, but then the price just keeps going. Several days stay in that upward direction, but not before creating this process, not before the necessity of creating a counterpart. If you want to buy and you're going to put a big order of buy orders, you need willing sellers, people that believe that the price is going to go down, so they sell, so on the other hand you can buy. we can see that the process stayed there and the price kept going several days to the upside direction. The accumulation process and the manipulation, it happens pretty much every day. As you can see here, again, see how the price goes up, goes a little bit lower, goes a little bit higher, goes a little bit lower than previous levels, and finally goes to one direction. This process is the same, doesn't matter if you're using a bar chart, or if you're using a time bar, or if you're using a open, high, low, and close bar. The necessity is the same, because what you are understanding is that the big players, they need to create the best conditions for them to put their transactions. This is the UK 100. Let's see other instruments. Let's go to the US oil. Here you can see how the price starts going up, making higher highs, higher lows, and the price comes below these levels. Imagine if you are somebody that is told that you need to buy with candlestick formations, with U-turns. You're going to have all those signals, you're going to generalize, but the reality is that a lot of times you're not being able to detect the process, so you understand in what part of the process you are, so you are most likely to go with the big traders, with the banks, with the institutions, instead of just randomly at the end guessing that this is the movement, this is the signal that is going to bring the price to the north, which the formation might seem the same, but the process, if you're not aware, is not the same. What part of the process you are can be repeated over and over again, but the formations, the symbols, always will be different and will be at different stages of the process. So the important part is understanding the process, so you are not just jumping because of a belief to trade just because it looks like a scenario that seems to be a profitable scenario. Goes below, now goes above this level, and then from there keeps going. If you bought right here and then you put your stop right here, is that a bad luck, or is just that you don't understand the sequence of the process? And then from there, as you can see, the price goes up, goes below these levels, and then goes up again. See, it's not that they just from here kept going up, but before going up goes beyond these previous levels, and then from there goes up. Remember, there's a need to have a counterpart. If I want to buy, I need sellers. If I want to sell, I need buyers. This is a process that is repeated and is very efficient and profitable for those that are the owners of the business because they have information. Now, the price goes above these levels, again, goes up, goes below these levels, and eventually goes below here. Now think about it for a moment. If you don't have anything else than candlestick formations, indicators, moving averages cross, support and resistance breakups, all those things make you at the end of the day buy at the worst time. You're buying with a decision candle, you're selling with a decision candle, you're buying right here when the resistance is breaking. In reality, what is happening is that you are buying high and you're selling low. And on the other hand, the big players are buying low and selling high. And eventually they're just going to keep going to one direction. Let's go see another instrument. We are looking at the silver against the US dollar. The price goes up, the trend is up, higher highs, higher lows, and then the price goes all the way below these previous levels. It stops. Here it seems like it's going to continue with that downtrend. The price goes up, so all those that thought or believe that the price was going down are taken into the wrong direction, and the price right here, you can see how the price reacts. Here are U-turns. It seems that the market is going to go quick and it's going to go up. There's always going to be somebody saying, oh, but you sold too early, after the fact. And then you're going to see, oh, past support becomes resistance, and you can even draw Fibonacci, and there's there's a 618. So it seems like an scenario. It seems that everything is happening, but then the price keeps going down, but then goes to the opposite direction. if you solve here, you put your stop here, or you put your stop here, what happened? At the end of the day, the process that we've been talking about is going on. Goes up, goes down, and goes up again. In our next video, we're going to talk about who needs this and how the process is very simple for those who are doing this process. But in reality, that the process is the same no matter if I see it in 15 minutes, 5 minutes, 10 minutes, 1 minute, 60 minutes. The time frame is irrelevant. The process is the same. So subscribe to this channel, and if you want to check more about this information, go to our website, Trading with Logic. This is Luis Morelos. See you next time.